Hi, Shae Russell here, editor of the Daily Reckoning Australia, and welcome to your first video for 2019. Now, this time of year it's often quite slow, so I thought I'd bring to you today my three big ideas that I think we're going to see play out over 2019. And they are the RBA and interest rates, the US dollar, and of course, gold. Let's get started with the US dollar. All right. Now, what do I mean by I think the US dollar is going to be a big theme this year? Now, it's not so much where I'm talking about whether the US dollar is going to be strong or whether the US dollar is going to be weak, but I'm actually talking about a US dollar shortage. Now, this was an idea that Jim Rickards and I sort of unearthed last year through our conversations, and it started because we were investigating emerging markets debt. But what we sort of discovered as well is that there is going to be a slow reduction of US dollars in the system. And I actually think 2019 is going to be the year we see that play out. Now, what do I mean by a shortage of US dollars? I mean, surely a few less greenbacks floating around is a good thing? Not necessarily. And the reason why is the US dollar is actually the linchpin of the entire monetary system. And because of the abundance of US dollars in the financial system, it enables the US to run their enormous deficits. So what we're seeing develop right now is that less and less central banks and foreign investors are buying US Treasury bonds. Now, this is important. The more US Treasury bonds that are bought, in a simplified way, the more the money the US can print. Now, that's about as much as we can simplify the concept. The problem here is if there's not a huge demand for US Treasury bonds, the US government actually can't print as much money as before. And that reduction of US dollars does put some pressure on the financial system. But more importantly, though, it puts more pressure on the US government because they won't be able to print as much money to continue running their enormous deficits. Already today, for example, I read that Donald Trump is trying to propose potentially a $1 trillion infrastructure program for this year and next year. Now, the only way they're going to be able to do that is if they get funding through US Treasury bonds. So what we're going to see play out over 2019 is going to be less and less international demand for US dollars and US Treasury bonds. And that could have a really big impact on the financial security, essentially, of the US economy. And this is the year that I believe we'll start to see this big trend play out. Now, the other thing too is we're not reading a lot about a US dollar shortage in the press at the moment. And the reason why you're not going to see a lot of it is because it's a very complex topic and it can be quite hard to simplify. But more than anything, think about it as like the subprime crisis. We all call the great financial crisis, we call it the subprime crisis. But really the cause of it was because of a default that happened over with AIG, an insurance company based out in London, which essentially caused the great financial crisis that we know. That's how I think we're going to review the US dollar shortage, 2 years from now. Now, it's on to the next topic, the RBA and interest rates. So what is the RBA going to do next? Now, this has sort of been the question for the past 2 years, or really since August 2016, when the Reserve Bank of Australia last cut interest rates. A lot of people have been putting the forecast out of when they would next raise rates. Now, if you've been a follower of my work for some time, you'll know that I've actually been saying that no, the next rate move will most definitely be down from the RBA rather than up. I don't think I can say definitely. However, I've long held the view that the RBA will not be raising rates and that they will be cutting them. Now, one of the reasons why I think they haven't cut them now is because consumption in Australia, so that is, the spending of money in the country, has been reasonably strong. However, we're starting to see that dwindle. I've been looking at data over the past couple of hours since I came back into the office, and there seems to be a long-term overall trend of consumption growth falling in Australia. So I wouldn't be surprised if this is the catalyst that the RBA will need to cut rates. Furthermore, compounding this problem is what we're seeing so-called now as, the credit freeze that the Aussie banks are doing. I think that's what it's being called in the mainstream press. That there is this reluctance to lend as property prices are falling. If you were following my work on the Daily Reckoning Australia, I did write an article about how I believe the RBA are going to try and counter this credit freeze by cutting rates this year. Look, you know, it's not really going to solve the problem. However, I wouldn't be surprised if over the next couple of months we start to see the RBA language change and they start addressing the lack of consumption growth in Australia, plus the credit freeze, as I said, that the mainstream are calling it, and start using these as the trigger to lower rates from the current 1.5% to 1.25% or even as low as 1% this year. So now let's move on to gold. It wouldn't be a video if I didn't talk about my favorite subject, gold. As you can see, I'm wearing my favorite recycled gold earrings today. Now, what is going on with gold? Now, when most people are starting to switch off from the markets for the year, gold went and surprised everybody by rallying $40 per ounce from Christmas Eve to New Year's Eve. Now, personally, for somebody like me, you couldn't ask for a better Christmas present. So that meant we kicked off the New Year's trading today with gold at $1,280 per ounce. So that's really good news. I've been looking for that gold bull market to come, and it finally came when the market wasn't watching. However, for Aussie gold investors, this rally has now pushed the price of gold in Aussie dollar terms well above that $1,800 mark. Now, the other thing that helped push the price back up to over $1,800 is also weakness in the Aussie dollar. Now, the Aussie dollar is currently trading at about 70 cents. So that really gave the Aussie dollar gold price a big push up to the 1800s. However, one of the things I think we're going to see play out this year is sustained weakness in the Aussie dollar. So what does that mean? The Aussie dollar is not going to go much above 70 cents, give or take a cent up or down. And I think what that will mean for Aussie gold investors is that we will see bigger rises in the Aussie dollar gold price compared to rises in the US dollar gold price. So if you're holding physical bullion, it means that the value of your physical bullion in Aussie dollar terms may rise more quickly than it is in US dollar terms. But also too, it means that if you invest in Aussie gold miners, especially the producers, they're probably going to be having a very nice fat margin from the wide disparity between the US dollar gold price and the Aussie dollar gold price as well. Not only that, if the RBA does cut rates like I think they will, that's also going to cause the Aussie dollar to fall even further. Look, I don't like putting too many prices on currencies because it all ends up a bit iffy, but I wouldn't be surprised if we see, if a rate cut comes through and the Aussie dollar falls substantially below the 70 cent mark to, 67, 68 cents. If that happens, we could be looking at the Aussie dollar gold price sitting around $1,900 per ounce. So could be a good time to be jumping in gold. So they're my three key themes that I believe we're going to see play out over 2019. I'll be back next week with more.